So our previous class was on this. We have done with the nominal returns. Today I'm moving forward with the next concept. So today what we'll do is, I think we have done this question. We have done this, yes. We've done this. We have done this one. Okay, so you can check this out. Already we in the previous session we have checked this. Nominal return is 1 plus real return into 1 plus inflation rate minus 1. We have done this question already. So let's go with this question. The following illustration, the following illustrates the calculation of NPV using adjustments for inflation. So as you know, we have right now seen how we make the inflation adjustment. Let's see what is happening in this question. Expected cash inflows after taxes 10,000 per year and will be adjusted to nominal expected cash flows. So you have to adjust this to nominal expected cash flows. That means you have to adjust this with inflation. How? This particular cash flow has to be given an inflation adjustment. So 10,000 in the year 1 into 1.03. In the year 2, 10,000 into 1.03 whole square. In the year 3, 10,000 into 1.03 whole cube. In the fourth year, 10,000 into 1.04 whole power 4. So in this way it goes, and you'll get the factors, and then you'll get the cash inflows, and then you will be like taking the required rate of return as a discount factor, and the factors are here, and then you'll be adding up all the cash inflows. Fine. And then you know you have to do depreciation tax shield. Is that all right? You know this particular thing. So what is your initial investment? Is 25,000. And what is the depreciation for this? They have already done the depreciation. They have given the amount per year 6,250. We have taken that, and then we have done the tax shield. That means we have just multiplied with this tax rate. This much we can claim as deduction. So need not consider this cash, this as a cash flow. This is the inflow for our business. And then you have to find out the present value of this particular tax shield amount. Okay, because or else you can do one thing, since like you can also go with this, like you can take this 10,300 and you can just add this 2,500, and then also you can find out your present value. But what they have done is they have taken this inflation adjusted cash flows, and they have discounted it. They have got the present value. They have taken the depreciation amount. They have done the tax shield thing, and they have found out the present value of that. Now 9524 plus 2312 would give you 11,836. So in that way, every year you'd get, and then you can find out your NPV. Come on, do this question, then we'll move forward fast. Once done, please tell me, I'll move forward. So done with this NPV question? Have you finished your NPV? Doing?
Yes.
Okay, okay, do it. Yeah.
Done, sir.
Okay, shall we move forward? Yeah. So this is done. How to do this you have understood. So we are discussing the summary of real versus nominal cash flows and rates. Real expected cash flow is a cash flow assuming no inflation. This particular cash flow reflects or incorporates inflation. In an inflationary environment, nominal cash flows will be higher than real cash flows. Why? Because this particular nominal cash flow incorporates inflation. Real rate of return is the return assuming no inflation, of course, and this has inflation. And nominal in inflationary environment, nominal returns will be higher than real returns because of inflation. And relevant cash flows used for capital budgeting. See, when you do a capital budgeting questions, what are the relevant cash flows you take? Of course, understood fact, you take initial investment. This is one of the relevant cash flows. Then you take working capital investment, working capital. Then you take, if at all you have additional investment, you take that. And you don't do IRR in that case. Why? Because when you have different cash flows, positive, negative, many times, you may have multiple IRR issue. Then you may take additional working capital if at all it is there. Then you would be taking operating cash inflows. And then tax is all are tax adjusted. Then you'll be taking depreciation tax shield. Okay, and then you'll be taking this scrap value. Like that means you will be selling the asset, so you would be getting its value. Okay, sale of asset, I would write to simplify the things. So these are all the relevant cash flows. Please make a note of this. If not, then you can also check this out. Okay, if there is a question in the examination and they ask you to find out the initial cash outflow, which you don't have a habit of doing yet. Why? Because in all the questions they have given the initial cash outflow to you and you have found out the NPV. But now if they ask you initial cash outflow, so you have to start from the end, or you should go in this way. So you should take capitalize cost of the new asset, whatever you have bought, plus the initial expenditures, capital expenditure. See, the initial investment or initial cash outflow is nothing but the one time investment what you're putting, and your investment is nothing but the asset what you're buying and the expenditure what you are incurring to make it to ready to use condition, that is installation and shipping cost, that is you are paying to bring that asset from one place to your factory. Then any kind of working capital increase decrease, increase you need to add up, decrease you need to subtract, or change in current assets, net change of current liabilities. Then you have to pay whatever taxes are there, you need to deduct the taxes from sale of old asset, and then tax savings. If at all savings, add gain, add loss, minus. So all these things are there, you'll get initial cash outflow. Okay, we'll see whether they have done a question on this or not. Don't worry, we will be doing questions on that also in your Gleam PDF, and I'm going to share you that PDF in a day or two. Why? Because almost all this chapter is coming to an end now. Okay, please do this. Just make a note.
Okay.
Next. Basic principles of estimating incremental cash flows. Sunk cost should never be taken. Why? Because this is a cost which, if you perform an activity, if you invest or you don't invest, this you always incur. This is a irrelevant cost or irrelevant cash flow, not a relevant one. This also should be ignored. Opportunity cost. Requirements for increased net working capital, that is the project driven increases in net current assets. That means if at all the working capital is increasing because you require more current assets and less current liabilities, maybe should be considered as a part of initial investment cash outflow. That means initial stages only this is done, and always working capital is to be recovered at the end of the project. Additional increase in working capital may be required midway through the project sometimes. If so, then it is a cash outflow in the year it takes place, and both the initial increase and the additional increase are supposed to be recovered at the end of the project. That is understood. Okay. So at the end, when you finish the project, you see both the amounts at a time. If the required rate of return includes premium for inflation, then expected cash flows must also include an inflation component. That means if inflation adjustment has to be done, given in the question, you should do it. Taxable operating cash flows are adjusted to their tax after tax equivalents, because we know already tax should always be deducted from your operating cash flows, and depreciation tax shield should also be taken. Okay, so please see how to find out incremental net cash flows for the period during the project's life. Then you have net increase or decrease in operating revenue, increase or decrease in operating expenses excluding depreciation, because depreciation is a non-cash expense, has no role to play in this. Depreciation tax shield should be taken, but never ever depreciation should be taken as a cash flow because it's a non-cash item. So here when you adjust increase decrease or increase decrease anything, you total it, you get net incremental cash flow before taxes. Then any kind of increase or see, this is incremental cash flows. We are speaking about incremental. That means we are only speaking about increase and decrease in this case, only increase and decrease. So increase decrease in revenue, increase decrease in expenses, then you get increase incremental operating cash flow before tax. Then increase decrease in income taxes, that can happen if the rates change. You get net this incremental operating cash flows after taxes. Then tax shield, increase decrease in depreciation expense for tax purposes in tax rate. That means the difference in the tax which you paid previously and now, the difference into the tax rate, you get incremental cash flow for the period. And this kind of questions they may ask in the MCQ. Please make a note of this. When we will be doing this, when we will be doing the MCQ questions, I will directly bring you to this particular thing and show you.
Okay. Okay, sir.
Direct questions on format.
Okay. Okay, sir.
Okay, let's move forward. Now we are speaking about the final year. In the final year, the working capital is always recovered. Then when you sell the asset, you get the money on that, and if at all you have a gain, you have to pay tax. If it's a loss, then you do the tax saving. That means you claim refund and proceeds from sale of that asset and incremental net cash flow for the period not including project termination considerations. That means at the end of the project, final year incremental cash flow you can find out in this way, where you can expect the working capital recovered, the taxes what you save if there's a loss on sale of asset, or the taxes you need to pay when there's a profit on sale of asset or gain on sale of asset, and the sale, the money which you get from the sale proceeds or disposal of the asset. Okay, just make a note of this even. Let's move forward.
One
So
minute,
now,
last line.
sorry.
Last line, sir. Finish the last line one.
Okay,
Yeah, done, sir. Done.
done. See, one more factor to be considered and given importance is risk in capital budgeting. It's one of the most important factors. Why? Every project what you take has risk. So we cannot deny this fact that risk isn't there. Risk is always there. And what we would do is, we would also take this as a factor when considering a project. Without risk factor, you cannot assume a project to exist, or you would invest. Okay, you would invest before like by not considering it. You would consider, understood fact. Now there would be a question. Let's see what is going on here and what the steps they said. Let us see. The more widely that potential investments returns are dispersed, the greater will be the potential for loss or gain. That means if you expected some cash inflow, and if at all the cash inflow is not as per your expectation, there's a lot of fluctuation or volatility seen in that, then we can expect that that particular project is a risky one. Okay, and when there's more volatility, there's more riskiness expected in the project. So in determining the various possible cash flows for use in calculating each year's expected cash flow, management must consider all this point. Determine which influences. See, what are the factors that influence your project? Like economic events, the shocks, which happened in the economy, like the COVID scenario was a shock for us because we didn't expect such kind of thing coming to India. We thought that that is only restricted to this stupid country called China, but even that came in India. And then we are suffering till now. This Omicron, some cron is coming on. Then labor conditions, labor, if there's a strike, then the production stops. There's a halt in the production, and you can expect again that would have an impact on your project. See, when you put your money, your investment, your hard-earned money, or investors' money, you understand this kind of like things you're going to expect. And in India, corruption is one of the biggest things. You have to bribe all the government officials and all. That is not mentioned here because it's United States course, but it is there in India. And international conditions have affected the net cash flows of similar projects in the past. So you can take a track of various projects and what suffering they have undergone. You can see that. Then you can see the probabilities of each influence or event occurring. That means what is the probability, or what is the what we say, the chances of all this occurring, and make assumptions about the effect or effects of each influence on the project. Okay, so we will do that. We will just take all this into consideration while doing this question. You can expect, you can just go for this question. क्लास होने के बाद XYZ company is comparing two capital budgeting proposals, both for 1 year projects and both requiring the same investment. So project A and project B, they're taking various scenarios. Okay, various scenarios. See, I can say these are scenario analysis or stress testing to some extent, which is one of the ways the risk managers would try to assess the riskiness in the project. Okay, so here the data and details are clear. They're comparing two capital budgeting proposals, project A and B, both for 1 year projects and both requiring same investment. Management has made several forecasts for the cash flows as follows: the economy in deep recession, and they expect this investment. In mild recession, this, then stable, this, and minor expansion, this, major expansion, you put more money. Why? Because in recession, if there's a recession in the economy, you would not try to take a bigger risk, correct? Now, companies economists forecast that probability of a deep recession occurring next year is 5%. So you will be taking the expected cash flows, correct? So these are the what they have given. Management has several forecasts for cash flows. So these are the cash flows they are expecting during all these situations and scenario. And then they have given all the probabilities, multiply and find out the expected cash flows. Please go for this and we will discuss. Do a calculation of this. Okay, so I think you have done the calculation, hopefully. Let's move forward. So the expected value of project B's cash flow, which is 3,25,000, is higher than the A's cash flow. That is what we are finding it, correct? However, a review of the ranges of the potential cash flows for both projects reveals that project B's cash flows is riskier because the range of possible cash flows is greater. Of course, here you are just putting more and more money. Okay, and since it is you're putting more money, it's more riskier, it seems, in those scenarios. Project B's lowest possible cash flow is 1 lakh and its highest is this, whereas project A's lowest possible cash flow is this and the highest is this. The range of project B's potential cash flows is 4 lakhs, whereas the range of is like only 2 lakhs. How? What do you mean by range? Range is nothing but the highest minus smallest. Okay, so highest is this and smallest is this. Highest is this and smallest is this. So range of 2 lakhs and range of 4 lakhs, more riskier. This range of potential cash flows is called the dispersion of the possible cash flows about their means. That means if there is an average, suppose if I take this and I draw a diagram of this kind, this is called normal distribution. This is the mean. For example, 10 is the mean, 12, 8. These are the deviations. We call it as dispersion. Okay, dispersion. You study the dispersion or measures of dispersion as standard deviation and variance. Generally you would not be exposed to more of statistics, but in risk management statistics has a bigger role to play, and it's a very crucial and high weighted subject. But in CMA you probably won't expect this. In CIMA, the UK based CIMA course has a lot of like exposure to those topics. Generally a cost accountant, management accountant should know all this even, okay, because they also perform risk management functions, it seems, in various companies. They may have been appointed for that also, maybe. So dispersion describes how much the individual data points are scattered or spread out around their expected value. As I said, how this is the deviation. So there's a deviation of 2% here. That means above or below the mean, how far you are. Suppose if I say this, and if I say, suppose 8 o'clock is what you have to come to the class, and you come to the class more often near to 8 o'clock, like very often you make a point that you always come on time, so your data would be this. That is, this is called kurtosis. Actually this is not there, so leave it. I don't want to confuse you with all this. So the deviation is studied by the dispersion is nothing but study of deviation. Okay, the narrower the distribution of the data, the lower the project is. That means the more you are near to the mean, the less risk. The more you are away, see, I'll just write down. If you have been told to come to the class at 8 a.m. more often, and you always make a point that you come at 8 a.m. okay, and like 7:45 is 7:45, 7:50 is acceptable, 7:30 is acceptable, no problem before this time, but you would complain yourself, why I'm coming on time or before time always. That is not going to fetch you anything. On time or somewhat before time is okay, but half an hour before time is not at all advisable, and no one asked you to do that extraordinary thing. But if you come at 8:05, okay, that's all right. 5 minutes late or 5 minutes thing are like those are grace things. But you always make a point out of 365 days in a year. You 300 days you always come at 8:30, so you would be punished. Am I right? This is a risk or not? There is a risk that they may fire you because you are not punctual. Isn't it so? Correct? Yes, Zarina. Hello.
Yes, sir.
Yeah. And if I say, so like the point here is, if you come at 8 a.m., that is, if you are making a point, you're coming always nearby to this, very less risk. But if you always make a point coming 8:30, high risk. So how much away you are from mean, it's risky. How much near you are to the mean, it is less risky. Okay, that's what they're making a point. So there are many risks, many types of risks which you would consider before investing your money. Market risk, non-market risk. Market risk is nothing but it's the systematic risk. Systematic risk is nothing but the risk of the system. If there is a market crash, stock market crash, every particular company's stock would get affected. This is non diversifiable because already the investments what you have done, uh, see, I would say, suppose this is a company X, you invested your 1 lakh in this. Okay, let's take a small example. This is a man, he has gone to the market. In marketplace he bought 1 dozen eggs. He put all those eggs in one basket, and the basket slipped from his hands. What would happen? All the eggs would damage. So they say don't put all your eggs in one basket. They say like that. There's a saying. Why? Because the highest risk is what you're taking here. But if he would have gone with 2 small baskets and he would have bought 6 eggs in this and 6 eggs and one of them dropped, this would at least save him. Correct? Now don't tell me that both of them he drops. No, no. Those extreme cases are not expected from responsible people. Correct? So
Yes.
I mean, sorry.
Yes, sir. Yes.
Hello.
Hello.
Yeah. Tell me, Zarina.
No, sir. Continue.
Yeah. You can enjoy the topic. It's a very good example to understand the portfolio view of investment. And if he just put 6 eggs in this, then again, if this he drops, actually like accidentally by mistake, then this he is taking home and he can consume it. The point here is, if there is a company called ABC, don't put your entire money in this company. If this company is in losses, you lose the entire money. It's like if you open one shop and put your entire investment in this shop is in losses, you lose. But if you open 2 shops, if one shop is not doing well, one shop is even in profits, then the losses of this can be absorbed with this profit. We see now many of these shops, they open branches in various places, and we say why he has opened a branch here, there is no customer. In other branch he may have lot of customers. So here he is trying to establish himself. Meanwhile there is minting good money, and if he is in losses even here, that can be absorbed with this. That means if this shop makes a profit of 1 lakh and this is in losses, on an average 50k we can divide between both of them. That is called portfolio way of investment. Correct? So
Yes.
so this is what, so don't invest your money in the entire company, like don't put all your eggs in one basket kind of concept. So here what they're saying is market risk. If you have already put your money, suppose you have 1 lakh and you have invested that in a diversified way into various investment options, and you don't have further cash to diversify, you have done the entire diversification. That means you may not get highest profits. Of course, you have minimized your risk by diversification, but even though you will not be getting the maximum losses. Why? Because your loss also has got diversified or divided amongst various investment options. But one thing what would happen is, here if there are 10 securities in which you have invested your 1 lakh, if this is a combination of risky and non-risky, and non-risky, I would say there are 3 investments, and risky 7. Out of that, highly risky 4. That means 3, suppose 3 companies are very highly risky where you can expect very high returns. 4 are somewhat less riskier than them, and 3 are non-risky. So these 3 which are highly risky, if they give you returns, it's a jackpot. This would give somewhat all right returns. This would give you 100% returns because zero risk and 100% returns. So what happens in this case, if this is giving you returns, the highly risky one, then there's a jackpot. If this is not giving you, if you are in losses in this case, even though these 3 non-risky ones returns, you can kind of compensate for this, or you can get a average return. Okay. So the point here, what I mean to say is, this is all right, but if there's a crash in the market crashes, then all 10 securities, even though whatever combination you have, whatever diversification you would have done, it won't work out for you because you will incur losses, because that is what we say, market risk is the risk. It's nothing but the systematic risk or the risk of the system. Here, even though whatever diversification you have done, if there is a market crash, everyone has to suffer. That's it. Interest rate risk is nothing but you have invested in a particular investment option and the company is giving you 5% promised interest, but in market the interests have gone to 8%. Your friends are enjoying 8% benefit, but you aren't. So that's an interest rate risk for you. Purchasing power risk is nothing but you your currency, whatever you have, okay, the purchasing power of that would go down in the future. Why? Because of inflation. Today something which you can buy for 10 rupees, you cannot buy the same thing for 10 rupees after 3 years, after like 1 year. So it is better you also consider this in your investment decision. That this recently happened with me. Even like 2 months back, I wanted to buy a doorbell and it was for 120 rupees and 125, like 100 rupees for example, like it was for 100 rupees. And then what happened, I just dropped the plan of taking that. I wanted something else, but after I did not get what I preferred. And again when I approached the guys, the electronic shop guys, for the doorbell, they said it is 150 rupees. See, out of like what has happened, the purchasing power, the inflation or the demand for doorbells has made the doorbells cost to go high, and the rupees value has come down in that case. Venezuela is a country whereby their currency's value is almost all nil. The currency is cheaper and the things are even more costly. For a bread, you have to pay 1 kg of their currency. You can do a research on Venezuela. Exchange rate risk is again when you deal in foreign, what we say, trade, export import, and you need to buy something from United States. You want to make a payment of $1 million to them, and if you make the payment today itself at the spot rate is $1 is equal to 75, for example, you make a payment of 75 million rupees. But if you want to make them the payment after 6 months, so $1 would have gone to 80. That means the US economy we are not seeing any boom in Indian economy as far as I'm concerned since our independence. In some of the years things have gone well, but I don't know right now why we are showing lots and lots of demand on dollar. Maybe we want to buy petroleum from Arab nations, we have to make them payment as per this, but like the demand for dollar is very high, so the cost of dollar has gone up, and now we have to make 80 million rupees payment, 5 million extra. That is an exchange rate risk. So we are studying about risk right now, not about the remedies, how to minimize this risk. That we will see afterwards. Then there are some non-market risk, like company specific, like there's a labor strike or shutdown or machine breakdown or fraud, etc. And there are the following is a partial list of kinds of non-market risks that could affect a project's cash flows. Portfolio risk, if you make a portfolio, diversified portfolio, and you have not taken a proper combination, then there also you can there's a fear of you losing your expected returns. Liquidity risk, you invested in some particular security or asset, and that is not easily convertible into cash. Financial risk, like you take money for your projects. If you take more and more debt, it creates finance risk and business risk. The change in technology, change in taste and preference of consumers, and a threat of new entrants entering into the market. All these are there. Okay, just a second, Serena.
Yes, sir.
So okay, then we are going into the next topic. So now we would be doing the analysis of risk with the help of a decision tree model. Okay, how to do that? It's very simple. See, this is called node 1. Okay,
Yes, sir.
and they have given a data. Can you just go for this data? We will have a discussion on this.
Okay, sir.
Okay. So you can see they have given some data, and when we discuss about that data, we understand some points. This is node 1. They are saying about economy, 60% chances that economy would be strong, and of course understood fact 40% it would be weak. Then there's a large store which operates under a strong economy. Small store also operating under strong economy. Weak economy, even there are large stores and small stores. And then these are node 2 and 3. And then here the economy being strong and there being a large store and strong demand is 75%. Okay, they have given the payoff in that case. And large store in a strong economy with weak demand is having this much cash flows. That is NPV. That is what they have given, the NPV, the net present value. Small store with strong demand, NPV. Small store with weak demand, NPV. Large store in weak economy, strong demand, 25%, because you see the economy is weak and the large stores demand would be less strong, and the large stores demand on a weaker side would be high. You got this point? Hello?
Yes, sir.
The probabilities are high. The it's in like in this favor, and small stores demand being strong is 25 and weak is 75, and the NPVs are given. And here you can see there's a loss even. So now what they're asking is, what we have to do, we have to find out the expected value. If the economy is strong, so we will find out the expected value of node 4. Very simple. You can take this 60%. Okay. Just they are saying about the node 4. There is a node 4. Okay. Just node 4. You can take 75% of this, the amount, plus 25% of this. Okay. Can you do that, Zarina? They have done this.
Yes.
Hello. So when you
Hello.
multiply
Yes.
probability with the cash flows, you get the expected cash flow. So 75% into this, 25 into this, 75 into this, 25 into this, 25 into this, 75 into this, 25 into this, 75 into this. and they have done for all the nodes, I think 4, 5, 6, 7. Okay, the question was to just find out the what we say, the expected value. Once you can do that, then I will explain you what is happening here.
Yes.
You can calculate.
Yes. Hello.
You are done?
Yes.
Okay. Okay.
The is about to shut down.
Sorry.
My phone battery is about to die.
Hello.
Yes. Hello.
Yeah.
Charging is like computer, so it's about to shut down.
Okay. Okay. You are charging.
Yes, sir. My phone.
So, like, shall we continue the thing tomorrow then?
Yes, sir.
Huh?
Yes.
Okay. Then I'm stopping here. We have to start from here. That means we need to discuss from this point, right?
Sure, sir. Yes.
Okay. Okay, Zarina. Then just go for this. Let's take the class tomorrow. Thank you.